It finally happened. The Federal Reserve hiked short-term interest rates. It is the first increase this year and just the second in about a decade. Rising interest rates could impact millions of Americans, including those who save, those who invest, and those who are thinking about buying a home. Interest rates have been near zero since the Great Recession. But today, the chair of the Federal Reserve said the economy has picked up, and she expects the momentum to continue. That could mean more interest rate hikes next year and cause the market to waver a bit, backing away from the landmark 20,000 level. So when all was said and done today, the Dow Jones Industrial Average snapped its win streak, falling 118 points to 19,792. The Nasdaq dropped 27, and the S&P 500 lost 18. So is the central bank ready to end the era of unprecedented monetary policy support? Hampton Pearson reports tonight from Washington.
Federal Reserve monetary policymakers ended their final meeting of the year with a unanimous decision to raise key short-term interest rates. A strong job market nearing full employment and some signs of inflation, along with expectations for more growth, were key factors.
Overall, we expect the economy will expand at a moderate pace over the next few years. Job gains averaged nearly 180,000 per month over the past 3 months, maintaining the solid pace that we've seen since the beginning of the year.
The Fed chair said the market rally since the election of Donald Trump as president and anticipation of fiscal stimulus, including possible tax cuts and major infrastructure spending, were all discussed by monetary policymakers over the last 2 days.
All the FOMC participants recognize that there is considerable uncertainty about how economic policies may change and what effect they will have on the economy. And insofar as that will affect monetary policy, of course, we will have to factor those policies along with many other things, including the global environment and oil prices and other matters.
The quarter-point increase was no surprise to financial markets, but the updated forecast for perhaps 3 rate hikes in 2017 caused markets to move lower after the Fed decision.
What this says is that for the moment, the Fed is not going to take away what the new administration giveth. And I think that's a positive.
The Fed is ultimately reactionary. There's too much uncertainty around policy. They actually have to react to policy, not promises.
The Fed chair said yes, there is a cloud of uncertainty about what lies ahead for fiscal policy, but also emphasized that forecast for 3 possible rate hikes next year is also a vote of confidence for the overall economy. For Nightly Business Report, I'm Hampton Pearson in Washington.